As mentioned, I'm going to be talking about employee retention credit information. Unlike William Godfrey earlier speaking about the accounting side of things, William Stunkel will be talking to you about the tax side of things. If you do have any questions, feel free to call us. We are very happy to work with our clients or folks who are not yet our clients to review this information. And when you call and if you have to leave a voicemail, you can easily leave it for either William, and we'll both be able to help you get to the right spot in terms of being able to review your situation with you. So just to start out, this is not a new provision in terms of 2022. This is something that started at the very beginning of the pandemic and has gone through several iterations. And so kind of the purpose of our talking about it this afternoon is because of the fact that, as we'll talk about later, the deadline to potentially apply for this credit is coming up in the future. There's still time to apply for it. And so we know there are a lot of clients as well as other businesses who are hearing either on the news or through I'll say cold calling from different organizations trying to promote this credit as kind of free money. And so we just want to make sure everyone understands kind of the ins and outs at least a very high level of how this credit works and ensure that there's no misinformation out there that you get roped into doing something that might come back to bite you if it gets looked at by the IRS. So as mentioned on the slide here, this was created under the CARES Act initially, and there are essentially two tests that are the starting point to see, okay, is this something that you can actually look to as a potential benefit to apply for? The first is a loss of gross revenue. The second one is either a full or partial suspension of your operations via governmental order. There's also kind of a caveat that it could be a supplier suspension of operations via governmental order. And so we'll get more into those details a little bit in the next couple slides. But the key thing to understand is that those are kind of the initial hurdles that you look at. And so the loss of gross revenue is what I would call the easy test, because if it's strictly just a test of using some math based on your accounting records, looking at your gross revenue in 2020 or in 2021 and comparing that to gross revenue in a corresponding period in 2019. And so it's simple math. If you qualify, it's comes out in the numbers, and the concern of someone questioning that qualification is very limited. The other kind of key aspect to just note is that word "or" is there in terms of the qualifiers. It's one or the other. It doesn't have to be both. And so if you don't qualify under the gross revenue test, you can qualify under the full or partial suspension of operations test. And we'll talk more about that later, as I mentioned. But it's just knowing that, hey, this is something we can look at. It's not just, okay, our revenue went up during the pandemic, and so therefore we don't qualify. There still could be some period of time that you can qualify with based on one of these two tests. As I mentioned, the time periods that are involved are, in 2020 from March 13th through the end of 2020, and then also in 2021, the basic, I'll say basic employee retention credit is for the first 3 quarters of 2021, and then there's a kind of a supplemental portion of the employee retention credit related to new businesses or qualified startup businesses that applies to the 3rd and 4th quarters of 2021. There'll be a slide later with some more information about that as well. On this slide, talking a little bit about the guidance the IRS has issued. Unfortunately, during the pandemic, most of the guidance that has been issued has been very spotty. Even with the employee retention credit, you'll see there are a number of notices here. Most of these are came out in 2021, as you can see based on the name of them. And so it's one of those things where what we typically look for in terms of official guidance, felt like it kind of came out kind of after the fact. I think some of that was related to the fact that the IRS knows that there is time to apply for these credits. And so while many people are concerned with trying to apply right away in order to get the funds that the credits allow you to receive, there is no need to necessarily rush through and try and get to the front of the line, so to speak. It's just a matter of once you get your return filed, if you qualify, and you're basically kind of in the line to get the refund. So kind of two key points on this slide that I just want to mention is that the notices there are like different notices issued for 2020 versus 2021, and that has to do with how the calculation of the qualification applies. I mentioned the gross receipts test earlier from the prior slide, and for 2020, the threshold for that is slightly different from 2021, and that distinction relates to the fact that in 2020, in order to qualify for the gross receipts test, you had to have a quarter in 2020 where your gross receipts fell compared to the 2019 quarter by at least 50% for an initial quarter, and then each subsequent quarter after that could qualify if that calendar quarter had your gross receipts had not exceeded 80% of your 2019 corresponding quarter. And so if you think about it in terms of you basically had to have an initial drop, and then until your revenue climbed back up comparative to 2019, you basically would still continue to qualify in 2020. In 2021, that gross receipts test changed to being a drop in your gross revenue when you're looking at a particular calendar quarter in 2021 compared to the corresponding quarter in 2019. Again, that's a key distinction to realize, is that you're looking at 2021 compared to 2019, rather than some people get a little confused and think, oh, I'm going to compare it to the prior year, but it's all comparing to 2019, not just to the prior year. And so in that case, for 2021 purposes, the drop in gross receipts has to be at least 20% compared to 2019. So if your gross receipts in 2021 were lower than 80% of your gross receipts in 2019, a particular calendar quarter in 2021 could qualify then. Additionally, in 2021, they added a provision where the prior quarter gross receipts could also be a way of qualifying for a current quarter. And so there's kind of expanded eligibility there on a quarterly basis that can be very beneficial. We've seen a lot of folks who in 2020 their revenue was down, but it wasn't 50% down. But then in the fourth quarter of 2020, maybe it was still down like 25 or 30% compared to 2019. But then in 2021, the revenue caught back up to what it was in 2019. But that first quarter then of 2021 would still qualify because the fourth quarter dropped in 2020 of gross revenue was still enough of a drop that that prior quarter provision for 2021 kicked in for them. The last thing then on the slide is mention that there are FAQs out on the IRS website. However, they are not able to be relied upon as legal authority. And so especially given the fact, as the last bullet point states there, that they actually haven't even fully updated them for everything that's been passed. And so it's a matter of knowing, as you're reading through things, it can be helpful to understand kind of where the IRS is coming from and how they're going to interpret certain rules. However, again, it's not authoritative, and so you can't technically rely on it when trying to make a basis for what claim you're going to file on a tax return. I mentioned this deadline earlier, and the key thing to understand with this is that you do have time. As you'll see here on the slide, April 15th of 2024 is the deadline based on timely filed 2020 tax returns for the Form 941s. And so for most taxpayers, particularly if you're using a payroll service, that's likely the date that's going to apply. 2021 quarterly filings then can be amended up until April 15th of 2025. And I'll kind of let you read through a little bit more of that detail there, but that's the key point, is that you do have time coming up here to file these amended returns and or kind of review what it is that your gross receipts have been, and or whether you've been partially or fully shut down. This slide just mentions, kind of highlights the fact that what happens if maybe you had a quarter that was late. And we've dealt with some clients where, during the pandemic, they had, a lot of struggles with, being able to be open. Maybe some of their staff were sick. And so they just, for whatever reason, administratively, there was something that was filed late. And the thing to understand with these quarterly 941 filings is that they're considered timely as long as they are filed by April 15th of the following year. And so that's kind of an interesting point to note, that at least in terms of the statute of limitations, that's what the timely filing is. That doesn't apply in terms of penalties and that sort of thing if you owe taxes and you file them after the due dates, but the technical due dates. But in terms of this credit and being able to amend the returns by a particular date, the April 15th of the following year is what kind of is the qualification. And so this just highlights, in the event that you maybe had one quarter where it did get filed significantly later than it was supposed to, it does adjust the date for that particular quarter that the statute of limitations will apply for being able to amend and claim this employee retention credit. This is what I would consider kind of probably the most helpful slide in my slide deck, related to the kind of just overall application of the employee retention credit. It mentions the percentages that you're looking at in terms of 2020 compared to 2019 and 2021 compared to 2019. So across the top is the particular quarters that each of the line items going down the chart apply to. And so kind of the couple things I haven't touched on yet is the difference in the 2020 credit, in that it's a annual limitation on the maximum credit and maximum wages that will apply or qualify for the credit potentially, where that's essentially $5,000 per employee is the maximum available for all of 2020. And then compared to 2021, where the maximum credit is $7,000 per employee per quarter. So you essentially could have up to $21,000 per employee in 2021 based on qualification. Another key difference to highlight between 2020 versus 2021 has to do with being an eligible small employer. And essentially what that allows you to do is the small employers, if there is any sort of gross receipts drop or full or partial suspension of operations, being a small employer allows you to count all of your employees who were paid during that period of time, regardless of whether they were working or you were paying them basically to stay at home. And if you're over those limitations, qualifying wages will only apply to employees who were being paid to not work. So if they were teleworking or still coming in and working, those particular employees would not qualify. Their wages would not qualify if you're considered a large employer. And that's what those thresholds relate to. Also, as mentioned, there is the recovery startup business category there at the very bottom. I haven't really talked much about the severely financially distressed employer, and that's because typically what we're seeing is if that applies to a particular employer, typically the other quarters also apply, and so it's kind of an interesting item they kind of threw in that just most other people are going to qualify under other provisions. And so we think maybe it was something they kind of threw in and maybe didn't quite edit properly when they were doing it. Next here, just to talk a little bit more about the gross receipts test. And so this is, again, kind of just giving a little bit more detail as an example of what that 50% drop of an initial quarter looks like in terms of whether a particular quarter in 2020 will qualify. And so in the second quarter, In this particular instance, they had that 50% drop in gross receipts. And then in the third quarter, they had a continued drop of 20% when comparing to 2019. And so both of those calendar quarters qualify, but the fourth quarter does not qualify given the fact that it was only a 0% drop. In terms of, that's when you start to look at the wages that for 2021, again, this is based on comparing 2021 quarter gross receipts to the same quarter in 2019. And you're looking at a 20% drop in gross receipts. And so as this chart is showing as an example, if you have a gross receipts drop in quarter one of 30%, both quarter one as well as quarter two will qualify, because for 2021 you have the prior quarter qualification option. And so because 2021 qualifies, or quarter one of 2021 qualifies, quarter two will also automatically qualify regardless of whether there is a drop or decline in gross receipts in quarter two compared to 2019 or not. So the area to talk about now is probably the one that you probably will continue to hear the most about going forward, I think, from a lot of sources, mainly because this is an area that's a lot of people view as very gray. And it's also can be fairly confusing when you're trying to look and say, okay, does a particular employer qualify? There's been a lot of, I'll say, noise out there related to whether or not a particular company would qualify as being partially suspended or not, based on certain governmental orders that were issued. And so I think it's important to note in this area that the IRS has issued guidance, and those notices I mentioned on some earlier slides, they do talk about kind of where the IRS views certain things in terms of, some of the more common orders that were issued relative to saying, a percentage of occupancy limitation or something of that nature, that for some types of businesses, the IRS views that as a kind of almost a automatic, yes, you will qualify as being partially suspended. But then for other organizations, types of companies, they basically came out and said, no, we don't think that's going to be an automatic thing. And so you can't just use that solely on its own as being a qualification. You're going to have to look really into the facts and circumstances of how you operate your business and be able to document that pretty well. So when it comes to this particular issue, I have listed kind of 4 steps that are required, in our opinion, to get to the point of having completely documented what is going to allow you to qualify as a partially or fully suspended company. And that involves kind of identifying the period of shutdown. And so what that's referencing is the fact that with the gross receipts test, you're looking at a particular calendar quarter that would qualify. And that whole calendar quarter, if you qualify under the gross receipts test, that whole calendar quarter is the period that qualifies. Under the fully or partially suspended activities provision here, the period of time is limited to that particular period of shutdown. So if you have a governmental order that only covered, say, a 2-week period that applied to your business, only wages paid in that 2-week period are going to qualify. You don't get to say, okay, that in a particular quarter there was a shutdown, and so the entire quarter will not qualify, only the specific time that you were shut down or had a partial shutdown. And so you have to identify when that period was in 2020 or 2021. The second part is documenting the governmental order that applied. We've seen some different shops out there that I'm going to touch on some of my last slide, kind of we'll call them fly-by-night operations that basically they will just have you as an employer, check a box and tell them, yes, I qualify, and they'll basically take your word for it and won't require any documentation. They basically say it's on you as the employer or as the taxpayer. Your company's the one responsible for documenting that you were eligible, and getting this governmental documentation can be some of the more difficult and time-consuming portion of determining that you are suspended fully or partially. And so it's definitely good to be aware of that when you are looking through what documentation you're keeping and making sure you have something that is a governmental order. It can't just be, a mayor having a speech and saying, hey, we want everyone to stay home. It needs to be an official documented order that was issued. The other thing then, the next step is determining what portion of the company was affected. And this is kind of an area, again, that is kind of generating a lot of activity in terms of whether you're considered more than nominally affected by a particular shutdown, if it was a partial shutdown. And so the key thing to understand here is that you're looking at 2019 periods of time to determine, was a particular portion of your company a larger portion or more than nominal portion of your company. And then based on, kind of hitting those 3 points, then you're able to determine whether you were shut down and whether you're what qualifying wages would apply then for the wages that were paid during that shutdown period in 2020 or in 2021. This particular slide just talks a little bit more about the details about that more than nominal determination. And it's one of the things where this is kind of we'll say the bright line test that is defined in some of those IRS notices in the official guidance they did give. And it's related again to 2019 and looking at what for a particular portion of your business that was shut down, whether or not the gross receipts or the hours of service in that period of time were basically more than 10% of your total gross receipts for your company, or 10% of the hours worked by your employees. This slide is just a shutdown example. So if you want to look through that, that gives you a pretty good idea. The last item I want to mention here, kind of in depth, is related to the aggregation rules. And this is pretty important. We didn't go into much detail on the slides here because it gets very in the weeds. But the key thing to understand is that if you have a greater than 50% common ownership, either in terms of a parent owning a subsidiary or potentially with brother sister corporations, there's a lot more analysis that you have to look at then to determine, okay, are you going to qualify or not? You can't just take one entity and say, oh, this entity qualifies. It doesn't have to worry about anything else. It can be intercompany based. And so as a simple example we have there related to a particular owner, certain companies become eligible, other companies become ineligible or have to be aggregated in order to determine their eligibility. And so it's just important to note that there are some distinct rules around that. This slide just kind of goes through, again, a little bit of an example of potential qualifying wages and the limitations on those. And a key thing to note is that wages that were used with PPP funds or used to be paid with PPP funds can't be utilized or can't be double dipped for the ERC. And so I would just say to be aware of that when you're doing any sort of calculations and being aware that if you're working with someone to prepare an ERC calculation in a credit filing, that they're aware of whether or not you use PPP funds to and how much of them were used for wages versus other qualifying expenses under the PPP rules. This slide just highlights that there are certain things that may not have been factored into your wages for your employees that do factor in for the ERC, mainly in the idea of tips. And so just being aware of that. And then also in terms of the small business qualification that was mentioned earlier, It's based on full-time equivalent employee limitations, and it's not necessarily just number of employees, it's the FTE equivalents, and that's actually based on the Affordable Care Act requirements, and we can certainly help anyone if they're coming up on a limitation for that in terms of number of employees. I also then mentioned the employee retention credit related to the recovery startup businesses. This just kind of talks more about what those limitations are. Again, I would be happy to talk with anyone that has started a business recently and to whether or not they will be able to qualify based on that particular provision. Last thing here is, again, we've seen and heard a lot of people, our clients especially, as well as other clients or other taxpayers, employers, receiving calls from people trying to basically sell them these credits, typically charging a premium price based on the percentage of the credit that they will be able to claim. And so just being aware that if you receive a call related to that kind of out of the blue, take it with a grain of salt. There can be a lot of pitfalls with that.